Having established what supply and demand are in trading, let's explore how to identify and draw these critical zones on a price chart. This skill is pivotal for implementing successful supply and demand trading strategies. The process begins by scouting for momentum candles on your chart. These are not your average candles. They are large, conspicuous, and signify robust buying or selling activity. For a zone to qualify as either supply or demand, you need to identify at least 3 consecutive momentum candles moving in one direction. This pattern indicates a strong presence of either buyers in the case of rising green candles, which would point to a demand zone, or sellers when you spot descending red candles, suggesting a supply zone. Once you've spotted these momentum candles, the next task is to determine the origin, the starting point of this forceful move. This origin candle is crucial because it marks the initial reaction point where the significant buying or selling began. With the origin identified, your next step is to draw the zone. Using your trading platform's rectangle tool, draw a box encompassing the high and low of the origin candle. Extend this rectangle to the right side of your chart. This extended box now represents the potential zone where future price action could react, offering you potential trading opportunities. Let's ground this with an example. Consider we're looking at the USD JPY currency pair. You notice a sequence of 3 substantial green candles moving upwards, a strong indication of buying momentum. The origin of this movement is a smaller red candle that precedes these green candles. You would draw your rectangle from the high to the low of this red candle and extend this zone outwards. This area now marked is your demand zone, and you'd watch this area closely for when the price returns to consider a buying opportunity. Conversely, for a supply zone example, let's turn to the GBPP USD chart. Here you find 3 large red candles heading downward. The last green candle before this drop is your origin. You draw your rectangle from the high to the low of this green candle, creating a supply zone. When the price revisits this zone, it might be an excellent opportunity to sell, anticipating the price will drop following the pattern set by the smart money's previous selling activity. Understanding the types of zones can further refine your trading. Supply reversal zone, rally-based drop. This zone forms after the price makes a significant upward move, stalls or consolidates, and then begins a sharp decline. This pattern suggests sellers overpowering buyers, creating a strong selling area. Demand reversal zone, drop-based rally. This pattern emerges when the price drops significantly, finds a base where it consolidates, and then shoots upward, indicating strong buying pressure overcoming selling. Both patterns provide strategic entry points depending on their context within the broader market trends and the strength of their formation signals. Spotting these accurately requires practice, but mastering this can significantly enhance your trading precision. To truly cement your ability to identify and draw these zones, let's practice with real-time charts. Open your trading platform, choose a currency pair or a stock you are interested in, and apply these steps. Look for the momentum, identify the origin, and draw the zone. Practice on various time frames and instruments to build your proficiency. Entry and exit points. Now that you're equipped with the skills to identify and draw supply and demand zones, it's crucial to understand how to determine the best entry and exit points. This will significantly enhance your trading efficiency by ensuring that you're not just entering trades at good locations, but also at optimal times. When it comes to entering a trade, patience is your best ally. Once a supply or demand zone has been identified, the common mistake is to jump right in. However, successful trading demands that you wait for the price to return to these identified zones. This is where the market has previously shown a strong response, and by waiting, you align yourself with the momentum carried by the smart money. For example, if we have identified a demand zone based on previous buying momentum, we don't immediately place a buy order. Instead, we wait for the price to retrace back to this zone. Entering a trade as soon as the price touches the zone can be tempting, but it's crucial to wait for confirmation that the zone will hold. This confirmation could be in the form of a price rejection at the zone or a reversal pattern, which signals that the buying pressure remains strong. Let's consider a practical scenario. You are watching the EUR USD. and it enters a demand zone you've marked based on previous buying surges. As the price touches this zone, instead of rushing to buy, observe the reaction. If you see a bullish pin bar or a series of accumulating bullish candles, this can serve as your confirmation to enter a buy trade. Setting a proper exit strategy is equally important. A well-defined stop loss should always be in place to limit potential losses. For a trade entered at a demand zone, set your stop loss just below the zone. This placement ensures that if the zone doesn't hold and the price continues to fall, your losses are cut short before they escalate. For taking profits, identify the next significant opposite zone as your initial target. If you're buying from a demand zone, look upwards on the chart for the next clear supply zone. Setting your take profit here maximizes your chances of capturing a good stretch of the price move while the market momentum is in your favor. Additionally, managing your trade as it progresses is crucial. If the price moves favorably, consider adjusting your stop loss to break even or using a trailing stop to lock in profits as the price moves further into profit. This dynamic approach to managing exits not only secures your gains, but also keeps you in the trade for potential extended runs.